Hello everyone and welcome to today's Mondac webinar in association with Axe Law, who will be exploring various fintech topics in relation to the GCC with a specific focus on Saudi Arabia and the UAE. My name is Dan Sampaio and I'm joined by a brilliant panel to take us through today's discussion. Karim Fawaz is the managing partner at Axe Law, where he leads the corporate technology transactions practice. He is one of the leading fintech lawyers in the Middle East and is highly sought after for his work on telecommunications, media and technology transactions. Prior to joining Axe Law, Karim led the Saudi-focused practice group of one of the world's 5 largest law firms, and prior to that, he worked at the largest foreign law firm in the Middle East, where he established and grew the firm's corporate technology practice. Mirko Olmos is an associate at Axe Law with over 5 years of experience in the legal industry. He is currently dedicated to advising fintech companies in KSA and the UAE, including multiple startups and one of KSA's first digital banks on its day-to-day legal matters, complex technology transactions, and fintech and regulatory requirements. Gianluca De Feo is an associate at Axe Law, where he advises clients on fintech, TMT, and commercial legal matters, including outsourcing, software development and licensing agreements, agreements relating to emerging technologies, data protection, regulatory compliance for telecommunications and internet operators, consumer protection, advertising, and corporate operations. Ali Nasser is a growth-focused entrepreneur and digital enthusiast and will be joining us soon. He is a co-founder of Ori, a company focused on democratizing access to private markets through blockchain and tokenization. He has had significant exposure to fintech and has contributed in building and investing in a number of startups focused on disrupting their sectors. Now, before I hand over to the panel to begin today's webinar, a housekeeping item. You can submit questions to our panel by typing them into the questions pane of the toolbar on the right-hand side of your page, and we do encourage you to get those questions into us. We will endeavour to answer as many as possible during our Q&A at the end of the session. Now, it's my pleasure to hand you over to our panel to begin. Thank you.
Hi, Dan. Thank you for the introduction. Good morning, everyone. We'll try to cover in this hour together a few takeaways and few points that are key in the market. And I would like to start with an overview of what is the current status of fintech in the GCC and especially in UAE and Saudi. We've seen in the latest years definitely an incredible development on the volumes of services and the nature of different services that are now offered in the markets. And I think it's relevant to start from, the factors that are driving these, the development of this ecosystem in this region, because it is definitely a peculiar region if compared to others, and a booming one. And I think we could boil down the drivers to actually two in this session, even though I'm sure that from a business perspective there will be much more than this. But it's clear that digital banking has become a way of life for consumers in this region, and there are definitely two drivers that I can think of right now. The first one is that the consumer base is increasingly tech savvy, young and diverse in backgrounds, nature of needs and requirements. And that allowed the development of different services and a wide array of services with a strong international reach as well, because people living in this region always have a strong connection with other countries as well. So in the fintech ecosystem especially, it's not uncommon to see a strong attention to services that enable international exchanges, especially on remittance services, for example. And so there's this very peculiar trait. And the other element that I think is relevant to consider is that the private sector here is well placed to cover and complete the demand for welfare services that is definitely increasing from the public government and providers, but currently consumers in this region have a high demand for welfare that is now being met by an offering from fintechs and technology companies in general. So these two elements are very peculiar to the region. And if you want to trace back the developments, we can start from what was the day zero of this industry. And definitely we started with payment cards and transactions, remittance, definitely cross-border. And after that, we've in the recent years, what we've witnessed is a very fast-paced development of other verticals in the business and in the sector, so that providers, although starting from the more traditional payment services with payment cards and easy access to transfer of value services, now have implemented within their own offering and ecosystem different verticals, and we can name lending, micro lending, embedded e-commerce, embedded cryptocurrency exchanges, insurance coverage, welfare, as I was mentioning, so pensions, investments. So now what we're witnessing is that all, or at least most of the providers are tending to offering an app that one could almost paraphrase Tolkien and say one app to bind them all, because the idea here is that consumers should be engaged with the app, should be engaged with the now I'm talking about apps because that's the most common way of delivering and engaging consumers, but I'm not strictly limited to mobile apps. But the idea is that the platform through which the services are offered is even every day more increasingly aimed at ensuring consumer engagement, ensuring that value to consumers is measured. And from this perspective, for example, we're witnessing a lot of developments from in the area of gamification and instantaneous, let's say, rewarding mechanism within the platform. So there's a lot of attention to that as well. And so we're seeing also cooperation between fintech providers and advertising, marketing, gamification providers that are enabling new solutions and new customer journeys within the app or the platform. And here also, yeah, along with the novelty element on this trade comes a compliance risk, especially in these years where compliance with data protection, consumer protection is increasingly important. We're witnessing now a very strong drive from the authorities on these two areas of compliance, let's say. So we have just had a recently issued complete framework for data protection in KSA. We expect that UAE will follow with a complete data protection framework. Similarly, UAE has adopted recently the implementing regulations for the consumer protection, which will have definitely an impact on how the app is developed, how the app is looking, how the app is looking and feel to consumers. Because at the end of the day, we do not need to forget that compliance with these kind of policies and frameworks does not remain abstract, and it does require the management to liaise with all the stakeholders within the company, and all the way down to the people that actually develop and implement the layout and the app itself and the platform itself, because there's a lot of attention currently on the way the app is presenting itself and the platform, the services are presented to end users. We should be careful not to mislead end users. We should be careful to inform them in a clear manner on the nature and trade of the services. So Compliance now, the compliance exercise is definitely intense, and it requires the involvement of different stakeholders within the company. But so we're witnessing attention on these elements from companies, and that's definitely good and in line with what the authorities are pushing for. So, and alongside this actually element that is more consumer facing, as on the other side of the coin, companies are increasingly aware of the importance of engaging vendors that are and that will enable them to deliver value to end users. So whilst on one hand, you know, there's a lot of attention to consumer-facing elements of the offering. Also, let's call it the back end of the offering is carefully pondered by companies. So the selection also from the procurement phase all the way down to the signature and the execution of agreements, we're witnessing attention to details and features of the supporting services that are procured by vendors that maybe stay in the background but actually enable the company to deliver value to the consumers. So this is definitely what is happening within companies in the recent years and months. Where do we see this going next? I think in the region, definitely there is a trend that is more current than others, and that is the trend of opening the financial services, the fintech services, to a technology element, and this is true, for example, for the open banking wave that is currently developing and investing in a good sense the companies within the ecosystem. For example, Saudi Arabia has been incredibly active on this matter, and since 2021 it declared publicly that it would have published a framework supporting the development of open banking, and this is this has been working very well for the authorities and for the providers. As it is common for other areas, the authorities have proven themselves to be very supportive of development. And the key issue here in this particular sector was and currently probably is still, the technology readiness of players within the open banking ecosystem, because what's happening is that financial services provided by traditional banks are no longer current, and traditional banks are shifting from their previous role within the ecosystem. So they're moving from a consumer-facing position to actually a backbone position. They're enabling other players to deliver services, financial services to consumers, but they are still definitely key stakeholders of the ecosystem. They're simply shifting away, and this from the consumer facing, this also entails a change in the technology that is adopted by traditional banks. And so the issue that we've noted, and it's and I think it's pretty common, is that banks are currently shifting from a technology that is built on a centralized model to a technology that is built on a more open access model. And this requires, of course, engagement of new providers or changes to existing agreements. So there's a lot of attention, and with attention comes as well to some extent some frictions on these elements. So agreements with providers of technology and suppliers of technology solutions that are currently on the rise, even if these are not necessarily consumer facing. But we can see that this exercise that is being performed by banks and with the support of the authorities and the fintech players is definitely worth it, because there's only one way this market can go, and the way it will go, from my perspective, that it will always be more open. So we're now witnessing the first wave of open banking, but what we'll see in the near future is actually open finance. So not only financial providers, traditional financial providers will be asked to give access and stop behaving like, as gateways, as gatekeepers of data with their consumers, but even other players in the ecosystem will be facing similar issues. So this exercise that is currently being performed by financial providers and technology providers will actually play out for them in the long term as a very good investment. So also from a perspective of costs and budgeting, because this current change in the structure of technology that is implemented within companies will be helpful and supportive for incoming changes that will be that we will witness in the near future. So I think this is a short and general overview of what's happening in the region. I don't know if my colleagues want to add something on this.
Thanks, Gianluca. I think that what you just said is extremely relevant, and it indeed leads to the next point of our presentation, which is exactly payments. So what I'll do now is I'll divide this in two parts. First, I'll just take what you just said about the background and explain it a bit focused on payments, and then I'll take a dive into the specific practical issues that we're facing now. So from what you just said, as a background in payments, we see that there is a clear shift towards digital transactions that in payments is supported by new and innovative solutions that currently coexist with legacy methods of payments, such as checks or letters of credit. And this coexistence, what it does is it creates a unique circumstance that is intensifying market competition, and at the same time, it's increasing options for users. But what my question here is, what's really prompting these changes? What's generating it? And what I think is it's that it can be seen from two perspectives. First, from the payment ecosystem itself, which varies depending on each of the countries, of the GCC countries. And second, from the perspective of each of the companies themselves that are part of this payment ecosystem. So first, new payment systems often arise from the creation of novel forms of commerce. So there is no payment without commerce, right? And now with the emergence of e-commerce, we have led to first an urge to enhance the effectiveness of the existing payment modes. So for instance, if I buy something online, am I going to send you the check? Or am I going to just click on pay and use my credit card? And second, there is a need to mitigate the specific risks associated with these existing methods. So if we were using legacy methods for an online transaction, who's going to send the good first? You, or am I going to send you the check? And finally, there is a need to address unique market demands. In this sense, if we only had legacy payment methods, it would be practically impossible to meet the demand of the millions of transactions that happen every day. Now, with payments as a fintech business models, there are three things that need to be tackled, taking this into account, which is first, trust, which is I believe that you're going to send me the good and you believe that I'm going to pay you. Friction, which is exactly what Gianluca was mentioning before, which is what fintech companies are creating is innovative ways to deal with frictionless transactions. And finally, cost, because it will not be the same me having to send you for instance, having to send you the check than simply having to click. And what we see in practice, and the companies that we deal with are the technologies that they use is, for instance, APIs that allow interoperability and sharing of data between software, cloud computing, and cloud-based solutions that allow the provision of services without having to have an on-prem infrastructure, which helps increasing scalability. We have seen biometrics, which of course allow to have an improved user identification and verification processes using fingerprint, face, retina, which also come with regulatory matters in respect of data. We have seen blockchain, both for payments and digital identity, and of course AI, machine learning, and big data, which are being used to improve data-driven decision making. Now that's on the background for payments. Now dealing specifically with the practical issues, what we often see is three main payment models that are being commonly used. We have peer-to-peer payments, both local and international or cross-border, which is remittances. We have C2B or customer to business merchant payments, also local and international. And finally, we have mobile money and wallets, which is, I'll explain later why I separate mobile money and wallets. But the thing is, and what we want you to understand is that each of these models come with their own commercial and regulatory hurdles. For instance, when we talk about peer-to-peer payments, if we limit the scope only to local peer-to-peer payments, we will be more often than not just talking about the national payment system as the payment rail, so as the connection of payments. But what happens when we delve deeper and go for cross-border payments or remittances? The legacy system is for this is using the correspondent banking as payment rails. So I go to my bank, and my bank then goes to another bank, which goes to another bank, which at the end goes to the final recipient bank at the other country, right? And then that's just highly inefficient. What fintech companies do is they come and use either self-developed or in-house or an in-house network or payment rails, where, for instance, one model is one company creates multiple entities in different countries and part of the same group. So when a transfer happens, instead of having movement of money, which is what happens with correspondent banks, as they are part of the same group of companies, instead of money moving, we have set-off, purely accounting set-off. And other companies which we're also dealing with, what they do is, yes, they do not create multiple entities, but what they do is they create their payment rails by contracting with other service providers. And it is here where we see multiple issues and concerns, such as what do we do and how do we deal with foreign exchange? When is the moment of conversion? What a specific number are we going to use, and who's going to choose it? Me, you? Are we going to go for instance, Bloomberg? How do and then we have, how do we deal with settlement? When is it going to happen? And even more, is it going to be pre-funded, where I pay, where we set up an account where I put money and then you set off, or is it going to be post-funded, where the service provider is going to deal with the money first and then we set off later? And moreover, we said that the legacy system is highly inefficient. So the question here is the service that I'm engaging you for going to be quick enough and efficient enough to serve my customers, and how do we deal with that? And finally, is it convenient enough? Which means, will it allow my customers to make transfers to any bank account, or will it be limited only to closed loop transfers, which means transfer within the closed ecosystem? How do we deal with this? We'll see a bit later, but it's basically agreements, and we just recently we wrote an article where we dealt with it. I'll tackle it later. For now, the second model that I mentioned is C2B, customer to business, where for here what entities do is companies may want to offer point of sale and e-store payment methods, that as a core, and then as part of that core, deal with analysis of transactions, determining top selling products, control of inventory in warehouse, or also, for instance, managing tables in a restaurant as part of this payment core, which will also help dealing with monitoring customer flow as part of the data that this core business helps gathering, which also creates additional issues. For instance, when I engage with you, when this fintech service provider engages, is it going to in a certain manner force the customer to only deal with one type of card reader, and how are the fees going to be set out in this case? And also, is, for instance, the transfer funds and the receipt of funds going to be considered a deposit under the applicable law, which will also vary depending on the country? How are we dealing with customer data contractually, which because perhaps as a fintech service provider, perhaps I'm interested in a certain manner having access to at least the metadata of these transactions to understand how the customer thinks and improve my services. And also, what is the impact on how do we warrant business continuity and on the logistics side of the business, and how me as a fintech service provider warrant that I am not going to be affected if you or if the merchant that's my client fails in the delivery of the services. And lastly, the last model here is mobile money and wallets. The idea and how this comes up is that they seek to bank the unbanked and make money transfers less complex than going to a physical branch of a bank, right? Which at the end of the day, the idea is to either partially or fully replace the need of a bank account. With this in mind, and what we see in practice is the concerns is, for instance, how is the treatment of mobile money different from other forms of fund transfers? And when we dig deeper, how do we ensure that the fees that we as a mobile money and mobile wallet provider, that the fees that we set are transparent? And even more, yes, say that we have a well-structured and fully set up mobile money and mobile wallet entity, and we want to improve the services that we are providing. How do we do this? Usually it will not be by creating new forms of money of money services, but by cross-selling, by introducing cross-selling as part of the business model. And by doing this, what companies often do is, okay, I have my customers, I have my platform. What can I do? I know what my customer wants. I know that they have money in my app. I can either bring service providers and offer them services, or create my own and offer them. So for instance, we deal with insurance offering. How do we do it? Can I do it myself as a company? Do I need to bring another one? Do I need to set up a new company that offers it? Financial products. I am a mobile money provider, not a bank. Can I offer financial products? How do I deal with it depending on the country? And also, when we diversify, and if I want to create a marketplace, how do I deal with it? Can I create a marketplace on my own if I have my mobile wallet app? What is the best way to make this work? And what we see is that companies deal with this thinking first, what is my business need? And second, regulation. And what companies often do is focusing in how do I increase the revenue by offering these new services, and how do I differentiate improving user experience. Third, how do I optimize my operational costs? And also, how do I protect myself by improving my risk analysis and detection of fraud? And with this, we have multiple ways of doing it. For instance, if we focus on user experience, there is a search of service level agreements and experience level agreements. If I want to cross-sell, how do I deal with financial exposure and the terms of the marketplace I want to create? And if I'm engaging third parties, how do I deal with a potential conflict of interest that may arise? And for this, what I recommend to you is we just wrote an article a few weeks ago where we tackle exactly these things that we mentioned. It's published on Mondac, and we would be really glad for you to go and access it. We'll share the link on chat if possible, I think. Thank you.
Thank you, Mirko. Okay, so moving away from this, I would say the overview on the payments, we're going to have a bit of a segue here from the initially planned, I would say, agenda or points of discussion. The reason being is there's been quite a lot of advancement on the regulatory side, whereby when lots of new fintech ideas, I mean, fintech, it's a broad topic, obviously. Long time ago, just started the payment card and a POS, so it wasn't really identified as fintech. It was just a payment method. And so with the area growing wider and broader, it became, I mean, there became so many pillars under the title of fintech. With that, what happened is sandboxes were created. There were few applicants at the beginning because they were yet to understand what's happening in those sandboxes. Are they really enablers? We're going now to the regulators to tell them what we're really doing, when some initiatives were done, I would say, avoiding the regulatory. So the approach was, if the regulation doesn't address it, then I might as well just do it under the radar and without going through a license or a regulation. And so, which is why things started, I guess, the sandboxes started becoming more attractive, more of an enabling environment. But bit by bit, regulations started to being developed, and they're actually there's a rush of regulation, which is to a certain extent now becoming let's say, it's something that is on the top priority of innovators and of founders of new concepts. With that, I would say there are lots of, let's say, now players or fintech, I would say, pillars that have already been regulated. And so we thought, okay, for the purpose of this webinar today, we've invited our friend Ali Nasser from URI. Reason being is, among all the other conventional, I would say, players, we saw there are still new ideas coming up, new, I would say, solutions, and there is still interest in continuously developing new solutions and finding themselves, in fact, regulated as opposed to circumventing the regulation, staying away from the regulators to give better trust and more, I would say, robust infrastructure. Ali, good morning or good afternoon where you are. Yeah, good afternoon, actually.
Good afternoon.
Thank you for joining us today. Eli, why don't you just tell us a bit about Uri? What do they do, and what's new about it in the market?
All right. Thank you for hosting me. First of all, apologies. I'm not a lawyer, so I'm an entrepreneur. So apologies for the dress code. Let me tell you more about what we're doing. So basically, we're focused on security tokenization as a topic. Basically, people confuse usually security tokens with utility tokens, and they confuse it with crypto as well. So in brief, just to tell you the difference, crypto is everything that has to do with all the currencies that are available out there, like Bitcoins, Ethereum, or any kind of currency that's out there. And basically, crypto has its own reserve. Each currency has its own reserve, and they're managed in a way. Bitcoin doesn't have its reserve, but it has its own way of managing the issuance of the coin itself. So we are more on the security tokenization side, and security tokens is everything that is tokenizing the underlying asset being a security. This is what we're focusing at the moment on. And security tokenization is a new topic in the world of blockchain, or in the world of tokenization in general. And currently, in all the for example, all the investments done so far in the blockchain and the crypto world, security tokenization was not at the forefront, and currently it's seeing the light, and many investments are done in that perspective. And we see, for example, like big players like Avalanche, they have secured a $50 million fund for real world asset investments. So there's a big appetite around the world for regulated and non-regulated entities to tokenize securities or tokenize a real-world asset, and in a sense that everything will be tokenized in the future. Things that we wouldn't have imagined, organs, our organs will be tokenized. They'll be listed on a certain organ bank, and things will be managed on blockchain. So we are focused on security tokenization, and the first business case that we are handling is tokenizing the private market world. So basically, private markets are inaccessible usually to everyone. Private markets are available to the high net worth individuals or the institutions that have that can participate with a high ticket. The minimum ticket in that space ranges above $300K, $300,000 and above. Some tickets are in a few $1 million. So small players, the average income person cannot participate and cannot invest in private markets. So they are limited to certain investment opportunities like the public markets. So what we are on a mission actually to democratize access to private markets. And to do that, we have to solve two problems. One problem is to lower the participation ticket, to lower the minimum. And we wanted to make the minimum as possible, depending on the regulator, how much they're open to that idea. And we wanted to make investment cost efficient and easy to be done. So this is why we're using blockchain, we're using security tokens. We're using security tokens to fractionalize a security, and to allow people to invest with a minimum of $500, $1,000 or something like that. So basically, we are in the business of security tokenization. We are in the business of democratizing access to private markets. And as Mirko was saying, talking about marketplaces, we are working on launching a marketplace where people can trade security tokens, and they can buy and sell, and they can resell in a secondary marketplace.
Interesting. But so you chose the GCC, let's say, place for you to set up and launch initially, ideally, as your tech, I would say, entity, as well as the regulated entities throughout the GCC, where depending on the regulatory requirements. When it comes to, see, as much as there is technology, there's a heavy financial aspect associated with the nature of business that you're handling. And so how do you see I mean, given the sensitivity, usually we're used to see us as lawyers, we see innovators pushing, we want to do more, want to unleash our capabilities from a technology perspective. How do you see regulators supporting the birth and let's say the enablement of such initiatives, especially when you see regulators not only, so there's the licensing aspect, but there is also I would say frameworks, for example, relating to cybersecurity, to other technical stuff. So how do you see regulators embracing that?
Okay, I'm writing the points. Okay, so look, basically regulators in the region, first of all, we're launching a worldwide version, Web3 version, out of the Cayman Islands, but we're focused, yeah, as you said, in getting regulated in each GCC market. And currently, the players that are accepting or that are open to innovative ideas related to that is Bahrain, Saudi Arabia, and UAE itself. So, look, at the moment, those regulators here in the region are innovative. They're open. They're willing to listen, but at the same time, they're also doing the Me Too concept. The Me Too concept is what's happening around the world. Can we replicate? Did it work elsewhere? Can we learn from it? Let's implement it here. So basically, security tokenization was a topic that was regulated in Singapore back in 2017. It started in Luxembourg in 2019, and then there were different follow-up regulations, updates in relation to that. But then at the end of the day, this part of the world, starting like back in 2021, is looking at security tokens and launching the regulations accordingly. There are two types of regulations that were launched. First of all, a fully fledged regulation like ADGM, where you can read everything related to security tokens and you can understand the different virtual asset regulations, from crypto to utility tokens to stable coins to security tokens or digital securities. And you can look at regulators like CMA, or in Saudi Arabia, they have written internal white papers. They have analyzed that topic, and they haven't launched any regulations, and they're open to listen to new business models and to new ideas, and accordingly accept those ideas inside the sandbox, the fintech sandbox, tailor make a license to their needs, and then allow them to launch in the market for a year in a testing way, test the market, allow certain investors to participate, and then see how things happened and learn from it. So basically, in general, this region is a follower region. So they follow what's happening around the world. They learn from things that happen, and they try to replicate, which is good, which is not bad at all. And what is interesting about this region is that they are eager to launch new regulations. They're eager to listen to new business models, and they're eager to innovate. So that's one thing. The other thing is that the aim of most of the regulators in this region is financial inclusion and empowering their citizens with financial tools. And we see how this region moved from non-banked to underbanked to overbanked in a few places, like in UAE, for example. So you see that financial inclusion is at the core focus of those regulators, and having new innovative business models or technologies will enable that they will enable acceleration of financial inclusion. So this is why they're open to new technologies. When it comes to data protection, cybersecurity, stuff like that, definitely they are worried about that. But blockchain as well, it enabled us in a way that you can build security on different levels. First level is the chain or the ledger itself, so it's decentralized in a way. You can build a hybrid model, which is a private and a public blockchain. So you can manage both. And you can manage the private blockchain. So by doing that, you implement your own smart contracts. And those smart contracts, they replicate exactly the regulations launched by the regulator itself. So you're able of actually using technology to properly manage whatever is requested by the regulator. Cybersecurity is a big topic, definitely. But then there are auditors, players, and third parties that would give you the proper audit and the proper testing for you to launch your fintech.
Yes. And so actually, you touched on a very interesting point, which is when you implement smart contracts that allow you to ensure compliance with the regulations. With things, regulations are continuously being developed, and there are more complex solutions. With time, I think also the first stab at the regulation is always, sometimes, despite being announced first for public consultation, and most, I would say, in most cases, the implementing regulations would usually require a refresh every now and then. But also you would see new regulators popping up, like VARA was established only recently with their own new set regulations. We are yet to see other changes in Saudi Arabia on those aspects. As you go through that, this will inevitably trigger, I would say, changes from a technical perspective to your own platform. Be it from a licensing perspective, you're no longer, for example, allowed to do a certain activity along with the other activities that you require in your license, which may not necessarily be supportive of your business model. How would you be able to manage this regulatory risk from a technical and commercial, I would say, perspective? Because the more those that regulatory risk may probably impact the financial model you have, and so your business will no longer be as profitable, and your business plan would be impacted. So how would you be addressing those?
Yeah, look, one of the main topics that regulators look at whenever they discover a business model, is it profitable or not? Would it be sustainable? Would it work? If not, then it doesn't make sense to license it. Because at the end of the day, if you don't have the proper fuel to continue working or to finance the operations, you will end up closing, you will end up liquidating, you will end up actually repaying back your customers, and it's a mess to do that. So basically, regulators, they look first of all at business models, if they would work or not, they would generate revenues and profits or not. And then whenever they launch updates, they make sure that those updates will have minimal effect on the available startups that are out there in the market themselves. Definitely, from a technical perspective, we have used, or we have seen many companies do that. So we use different types of architecture that is modular in a way that enables us to change fast according to the regulation. So for example, updates in KYC happens constantly. How updates in FATCA, AML, counterfeit terrorism, any updates in onboarding. So onboarding has become like a big topic around fintechs, and requires a very flexible workflow system in order to update the system according to the updates forced by the regulator. So yes, we do use modular architecture. We do use workflows that are flexible in a way that you can adapt them. We use smart contracts to reflect the regulations, and technically, as I mentioned before, we use a hybrid model for blockchain to make sure that we're capable of managing our own requirements that reflects the regulatory requirement, and then we will connect using bridges to the public blockchain. When it goes to commercial, as I mentioned, commercially there is a big impact, but that impact is minimal when it comes to incremental changes inside the regulation. Initially, when you're applying, they look at the big picture and they look at if your business model makes sense or not. And this is where the regulator will start discussion. Will start the discussion with you. I hope I have answered your question.
Yes, that was actually very helpful. Eli, thank you so much for being with us today. Thank you for your valuable input.
Thank you for your time.
All the best for Uri's launch in the region. And yeah, thank you.
Thank you. Have a nice day. Take care. Bye-bye.
Thank you, Eli. And so yeah, working on those new initiatives, I would say it's interesting because also the benchmarking is happening usually on the international markets, on the bigger markets, leading markets, and I would say the terminology used is usually based on English language, which is not necessarily matching with other languages, at least for us in the GCC. I've already seen some, I would say, inconsistency or probably at this some, I don't want to call it inaccuracy, but different ways of identifying a certain term which is used in English to be in Arabic. So, for example, like tokenization, I haven't seen a unified term in Arabic that accurately reflects what tokenization is. It's been inconsistent. There is obviously one correct term, but we can see that regulators are not necessarily aligned on the terminology, which will inevitably reflect on the regulation. It creates an uncertainty that then us lawyers would have to say, we assume this refers to that because regulations are based on, well, at least in our region, is based on an initial phase, which is benchmarking. And so we rely on the international markets to analyze what the intent is in that specific article, clause, or a specific term. And so moving over, just conscious of time, I just wanted to quickly catch up on a few points, like where's the market heading? On one hand, we've seen new companies come, new ideas coming in. There's been at some point on certain, for example, payment services popping up here and there. Some of them had a very nice successful story. Some of them became unicorns, but also some of them didn't have the, I would say, the market penetration that they would have hoped for, and so they're not reaching where they want. Also, with the change in regulation, it became kind of burdensome on the smaller, I would say, projects to operate and to be profitable. In which case, again, our view probably partnering with each other. So if you look at the evolution of fintech, I would say, take it on the wallets, for example, it was the big conventional players, i.e. the banks, against those smaller companies who were looking for someone just to host their custody accounts or their client money accounts. And so they were not getting the innovators were not getting the required support, not from the regulator, but more from other, from the, I would say, legacy players who simply have a conflict of interest with having those new companies succeeding. But so with time, then they made friends, I would say, and I guess where we're heading now is I would expect there will be more market consolidation. So some smaller initiatives, companies who have a good infrastructure, technology, but not necessarily successful on the business side of things. These will be targeted by I would say, bigger players, could be even by legacy players who realize that, no, we do want to work with these innovators. We do want to refresh our systems, and the best thing to do is acquire those teams by acquiring their business or their model, etc. So we suspect that there will be some market consolidation on that. Otherwise, there will be, I would say, probably elimination or winding up, or I would say exit of the market based on the regulatory market exit strategies that would be agreed. I'll just keep my part short here, and because I can see we have a few questions. And
Yeah,
I'd like to
I
hand
think there
over
are a
to
few of them.
Yes.
I think there are a few of them that were already answered. So on, for example, the likelihood of developing a global standardized cryptocurrency framework, and but we're happy to follow up on that separately if necessary. I think there's one question that we would like to answer that is on someone in the audience is asking if a service provider can process the data of one client for the provision of future services. So if the data of this client are already processed by the service provider, can I process this data for further services that currently are not provided by the company? Depends. It depends if we're covering here the personal data and not the credit and other data that do not qualify as personal. So to the extent that we're talking about personal data here, it depends on the legal basis that is being used as a ground for the processing, because generally in this case what you would have is the processing of data based on the legal basis of execution of the agreement. I'm processing your data because that is necessary to perform the agreement and deliver to you the services. Now, if you are using this legal basis, you should assess the necessity element of that processing. So to the extent that that processing is necessary to deliver the data, then yes, your processing is lawful. But if you're processing data for services that are not yet delivered, then you're failing. There's a failure of meeting the requirement of necessity. Now, it would need to be assessed where exactly this provider is based, because the standard and the bar of the necessity requirements varies across the countries. So that would depend. But if you're using, for example, consent as a legal basis, although I'm not sure this would be the appropriate one, for the delivery of services, then consent must be specific for one exact processing. So if you're using consent for the processing of the current services, then that is okay, but you would need to seek a separate consent for the processing of future services that will be delivered. Now, another point to consider that could be evaluated is whether you have a legitimate interest to process that personal data for another purpose or not. So there are ways in which you could implement a data processing policy that is compatible with the legal protection, with a data protection framework. It depends also on which data protection framework, because there are multiple data protection frameworks here in the region. But we're happy to support you if we can.
Thank you, Gianluca. Yeah, we're almost at the end of today's session. I hope everyone found that useful and interesting. We try to touch base on some of the practical stuff as opposed to the boring black and white text that you would usually easily access. Please, I know there are probably other questions that we didn't have time to address. Please feel free to follow up with that later. We'd be more than happy to keep the discussion open. Otherwise, thank you, everyone.